Welcome back. Earlier today, the PCE personal consumption expenditure was reported mostly in line. The yellow histogram bars here show us on a month over month basis. The red is the course PCE, excluding food and energy. What we're going to see in a moment is how this may not be reflecting the true effects of inflation. Overall, we see on the left-hand side 0.4% month-over-month basis, PCE 3.4% year-over-year. For PCE, which excludes food and energy, which is basically everything else, clothing, that sort of thing, that's up 0.3% on a month-over-month basis, year-over-year up 3.7. So excluding food and energy, we actually see a little bit more inflation than including those more volatile components of the index. Here we see in yellow the PCE year over year has a positive correlation with crude oil, which certainly makes a lot of sense. Crude oil and energy prices play a dominant role in this number. And now that crude oil is back to the upside, we also see inflationary pressures also continue to rise. PCE is charted here, overlaying federal funds interest rates during very low periods of interest rate. We see inflation skyrocket. The Federal Reserve has raised rates precipitously to calm inflation, but it just doesn't want to get back below that 2% target level. It's quite stubborn. Here in blue, we see PCE year over year. In red is the S&P 500. Notice a little bit of a delayed reaction where the S&P 500 hit their highs late 2021, early 22. But 3 or 4 months later, the PCE had hit its own high, which this does make a lot of sense because the stock market is a forward-looking indicator in the sense that we're all buying and selling stocks, trying to guess what's going to happen in the near-term future. But with that said, the weakness in the stock market that we've seen, especially lately, will that translate into lower energy prices, lower inflationary pressures? Maybe the Federal Reserve doesn't have to raise interest rates. Now, we have two popular measures of inflation. It's CPI, Consumer Price Index, and PCE, personal consumption expenditure. There's a few differences between these two reports. One of the major differences is the CPI uses data from household surveys, from us, the consumer. PCE, which was reported today, primarily takes her data from GDP reports and also from suppliers. So, with that said, we can consider CPI versus PCE. CPI in yellow, PCE in red, but specifically take a look at the black histogram bars in the background. That's CPI divided by PCE. So, in other words, when the inflation that we, the consumer, experience, when that's more than what GDP reports tend to reflect, this line goes up. What it's showing us is that the inflation that the average consumer is experiencing is more than what the GDP report is reflecting. So, certainly, if the Federal Reserve chooses not to raise interest rates in the near term future, in part due to this PCE report, it doesn't mean that inflation's gone away. It just means inflation that they tend to measure that has subsided. Here in yellow, we see PCE on a month over month basis of 0.4%. The core is excluding food and energy. That's up a little bit less. So we can see that the inflation we're experiencing, it's not only gas stations and supermarkets, it's actually a lot of other places as well. Now we see here PC on a year over year basis. This is year over year. Core PC in red, year over year also. A continuous decline to the downside, which is encouraging, which does give the Federal Reserve fuel to maybe not raise rates as aggressively as they have been. But again, what we just saw is that CPI is reflecting a greater rate of inflation than PCE. So this is declining, but it's declining because it's maybe not measuring the same thing that CPI is. Here we see PCE in blue, core PCE in red, and then we have the black line, which is a 2% Federal Reserve target. And the Federal Reserve has said over and over again, that they will not stop raising rates, or that at least they will not cut rates until inflation gets back down to 2%. So, a couple takeaways from this: PCE versus CPI. The personal consumption expenditure, which is harvests their data or relies on data mostly from GDP report that we just actually saw the other day, that's a little bit lower than the consumer price index. That consumer price index measures the rate of inflation that consumers experience more likely to. So regardless of that, all levels are still well above the 2% level. We're still in the healthy 3% range. So the Federal Reserve is not opposed to lower interest rates anytime soon until we get back down to 2%. So today's number is a little bit softer than we might have expected, but it's still high enough to justify higher interest rates. And the stock market certainly, I think it's growing tired of these higher rates because it just makes it more difficult, to do business and borrow money. But we have a big economic calendar next week as well, and we have over the weekend a very special GDP report. We're going to dive into all the details of the latest report, so please keep an eye out for that as well. We hope this has been helpful. We look forward to seeing you back soon.